Good morning, everyone. Welcome to this update for global stocks and commodities for the 18th of March. As is normal when markets get a bit nervous, and I think we're going to see a lot of that in 2018, it goes looking for problems. Sentiment has moved backwards and forwards between being positive and negative over the last couple of months, really, since we had the correction at the start of, or in fact since the start of the year. January, incredibly positive, became exceedingly overdone, and then we got a correction in February, and now the fluctuations in the market are tending to settle down. But nevertheless, that sort of volatility does cause people to look for problems, and certainly there are some headwinds from perceptions about what might happen. And I must stress, these are not problems yet and may never turn out to be that way. But certainly the anticipation that things could be an issue is being just holding the market back a little bit at this stage. So in this update, I'm going to be looking at why some parts of this market at least can keep going for a long period of time. And I think you'll find this a very, very useful perspective. And from my point of view, one can't ignore what we've got at the moment, and that's a very powerful combination of both fundamentals and then also a multi-year breakout by the leaders of this market, and that's the technology sector that's led this market now for probably about 3 years. And a lot of people who are not necessarily looking back far enough have, I think, missed the point that the technology sector has just finally broken out above its 2000 highs. So that's 18 years, and that's quite a significant event. And of course, I'll be looking at the normal stock and commodity trend updates. Portfolio analyst last week was in another session that I got a lot of good feedback on. I did look at a number of things, including US sector relative strength and also some high-flying stocks in Australia, some of them speculative, some of them higher quality stocks. Let's just have a look at the technology reality of what's happening around us and these trends. It's extremely difficult to envisage what is going to disrupt these trends. And the things that I'm referring to are obviously the Internet of Things, and there's just so many aspects to that includes smart homes, driverless technology, streaming media, the list just goes on and on. Helping to fuel that, of course, and expand the rate of growth is going to be the onset of 5G technology, and where we have 5G technology in a very limited way in Australia now within some parts of the business community. Artificial intelligence, of course, and another theme that I really like is mobile payment technology. I don't think anyone could really argue that those things are going to all continue to advance at a great rate, and that is going to provide the fuel for the technology sector to continue to expand. The semiconductors, which has been the leading industry group within that technology sector, and they provide obviously the silicon chips that go into all of these applications to do with technology expansion, and it's really just hard to envisage anything other than a continuation or an acceleration of that use of silicon chips. So that's what's happening around us, specifically for technology. Let's look a little bit more broadly and consider the global picture. Now, the OECD economic outlook for 2018 and 2019 is for close to 4% growth. Now, I take these sort of forecasts from groups like the OECD with a truckload of salt, because they're often not close to the mark, and they're often got their timing considerably wrong. So I'm not placing a massive amount of stock in that. But the fact that they've ramped up it's really the direction, I guess, that I want to make note of. They've significantly increased their expectations for economic growth over the next 2 years from low 3% to 4%. And that's significant. And I don't think from what I'm seeing that they're probably going to be too far wrong, at least in terms of the direction. So the prospect of a recession is just not even in the conversation at this stage, and that's going to be very supportive for stock markets. Specifically, we're seeing still terrific expansion of retail sales in China, industrial production in China. I'm talking 7 to 9% growth rates per annum. These are still very robust rates, and I think China is doing a pretty good job of managing a very difficult transition. Now, the expectations are that US earnings growth is going to come in at 17% for the first quarter of 2018. It was 11.7, I think, in the final quarter of 2017. So that's a significant step up. And you've got to remember that the track record over the last 5 years or so is that the actual earnings have exceeded the expectations consistently. So that's a big number, and if the historical trend continues, then the reality might even be better than that. Now, a lot of people are still concerned about US valuations, but I can tell you that US valuations have actually come down slightly. At the peak a couple of quarters ago, the US valuation for the forward PE was about 18.2. It's now down to 17. And that's only very slightly above the long-term averages. And this is at a time when the economic growth has never been better. Corporate earnings have never been better. We've got tax cuts. We've got global synchronized growth. We've got a $1.5 trillion stimulus package for infrastructure in America. The list just goes on and on. So I'm extremely comfortable with where the US valuations are at the moment. And if you look at the fact that the forward PE ratio is not increasing, in fact, it's coming off very slightly, means that earnings growth is at least keeping pace with the growth in stock prices, and possibly stock price advance is falling a bit behind the earnings growth. So I don't think there's any cause for concern over valuation of stocks in the US at all. So that's all the fundamentals, and it's quite a big tick box of positives. And then we come to look at the chart of the overall technology sector in the States. This is the chart of XLK. We've just broken out above an 18-year high. But more importantly, this is not just about the FANG stocks, about Facebook and Amazon and Google, etc. The breadth in the technology sector is enormously high. I forget the exact number, but it's somewhere in the mid-80s of the stocks in the sector are trading above their 200-day and their 50-day moving averages. So the breadth is extremely high. So let's take a look at that XLK, because it really does tell a very graphic picture. So let's go back to the peak. So here was the peak in 2000, when certainly the NASDAQ got well and truly ahead of itself, and technology got well and truly ahead of itself, and formed a peak at $65.20. From there, the technology sector absolutely fell apart. So it fell from $65 down to $12 by 2002. So lost more than 80% of its value. We then bumbled along the bottom between 2002 and 2009, when the current technology market took off at around about the $14 mark. And you can see just recently we broke out. That was in late January of this year. We then got a correction back. And so at the moment, we're just fluctuating above and below. But you'll notice that we've quickly regained the pre-February correction highs. and we've broken above that just in the last week. So 2 weeks ago, we broke to new highs, a little bit of a retracement last week, and this may just continue around this level between, say, 65, 66 and the low 70s. We may get a consolidation here for a while. That quite often happens after a major breakout. But I can tell you that now that we have broken out, the odds are that this continues on and continues on for a very long period of time. Now, if it's taken 18 years to affect the breakout, it's not inconceivable that this could run for another 5 or 10 years. Now, that won't be a straight line. There'll be volatility, but I think there is no question that the underlying trend and the underlying momentum is very much to the upside. And if you combine that with what I spoke about before, with all of the unfolding developments in technology, it's pretty hard to argue against the premise that technology could continue to lead this market for a long, long period of time. Now, I'll just point out the bond market, and I'm only just sort of raising this as something that I'm watching, but it's not something that I'm concerned about at the moment because the signs are just not there to warrant taking any action. Now, I just make the point that the players in the bond market are far more experienced and far smarter than the average institution that operates in the equities market. There's a lot of low competence people that are operating in the equities market, not so much in the bond market. So we are seeing some warning signs. Now, I watch the bond market, various indicators constantly, basically every day. So there are some warning signs there, but look, they could just be reflecting the fact that we're going through a period of adjustment from higher rates, to higher rates and a significantly higher US debt. The US deficit is already extremely high, and Trump is looking at adding on quite a few layers on top of that. So the US debt is going to continue to march higher. So on the face value, if you look at these indicators in the bond market, the face value is saying that credit risk is rising, but that may not turn out to be the case. That is just what the bond market is trying to anticipate at this point in time. So the reality is that it's too early to tell, and it could be quite a lengthy period of time before that situation clarifies itself. So it's just something that I watch. It's something to be aware of, but it's not something that I'm concerned about. If you wish to watch that yourself, keep an eye on either the 2-year, 10-year spread for that to what's called invert. So in other words, the shorter term interest rates become higher than the longer term interest rates, and that almost invariably signals a recession. And you tend to see that about 6 to 12 months before a recession actually hits in terms of GDP going backwards. But we're certainly not at that point yet, and we'll have a look at a chart, a similar chart to that in just a minute. The market worries about inflation and about trade wars, and there's a few other things in there as well, a few geopolitical things, but the market is concerned about inflation and about trade wars, and they may or may not become an issue. But I'm always strong on you react to what becomes a reality. You react to what the charts are telling you rather than trying to anticipate what might happen. So inflation and trade wars are worth monitoring, but they're certainly not worth reacting to at this point in time. The economic backdrop is really good. The trend momentum is up, and because of the way that the market operates, that becomes partially self-sustaining. Major funds and the major smart money players get rewarded by outperforming the S&P. So we're better placed to continue to outperform the S&P is with the stocks that are doing that. And so it tends to set up this self-propelling move to the upside. Now, just a couple of charts to consider. This is US inflation. That doesn't look like inflation is getting out of hand to me. I don't know what some people see in that, how you can become fearful about inflation by looking at that chart. So I think people are just trying to anticipate what might happen. But if you think back to 2011, when the Fed really started to ramp up the money printing, people were worried about inflationary breakouts in 2012 and 13. That's 5 years ago and it hasn't happened. So I'll wait and see until we actually see some evidence and we start to see inflation above 2.5%. Now this is the yield curve. This is a 3-month, 10-year spread, which is similar to the other one I referred to. And where inversion occurs is where that spread goes below zero. You can see that occurred in the early 1970s, 1972, 74, when we had a recession. And then in the early 1980s as well, we got dips there that precluded a recession. Since then, we had a little dip into the negative around 2002, just a tiny one. But since then, we haven't had a recession and we haven't had the yield curve going into the negative. So that's the reality at the moment. We haven't got there yet. Let's turn to American stocks. So that was a fairly long-winded backdrop, but I think it's really important for you to understand that backdrop because the volatility this year will be higher. That will inevitably mean the commentary will be about doom and gloom and how the market is going to fall apart. And that can tend to concern traders and investors. So I think it's really important for you to have a clear perspective on the big picture and what's really going on. The S&P was lower by 1.2% on the week, but as I showed you in the last chart, technology just remains the undisputed leader. China stocks were on the move again. They had a good finish to the week, so that's positive. And the S&P index is moving higher within a channel, and that channel is just going up at the same rate as the entire 2017 trend. So from my perspective, February was just about the correction we had to have. We've returned to trend, and now we're rising again at trend. So that's about all you really need to know about the market at this point in time. And the US dollar, of course, we'll have a look at that. That's still hanging on to critical support and rose a little bit into the end of the week. So let's take a look at the S&P. So let's just pan back and take a look. So there's the trend for 2017. So pretty clear, the market index was just a little bit above and below trend throughout the year. Then in December, we started to accelerate, and then in January, it really went parabolic and got miles above trend, and therefore had to come back to that trend, which it did. It overshot, went down to the 200-day moving average and bounced very, very clearly off that. And as you can see now, we are just basically tracking in line with the trend that we saw throughout. Let me just move that up a bit so that makes it a bit clearer. So I can't see there anything other than a continuation of a move higher within a channel. Now that channel is, yes, it's more volatile than what we saw back here. We only saw fairly mild moves above and below that trend line. Now we're seeing far more substantial moves above and below that trend line. But the direction is still to the upside. And I think that's all you need to know at this point in time. Let's look at the US dollar index. So it still hasn't done anything of real note there, just holding on to that base that it's carving out between 88.5 and about 90.5, but showing signs of probably moving higher. It's looking like it's moving more towards the upper end of that range, as you can see. Turning now to Aussie stocks, our dollar fell sharply to 77.2 on Friday night, considering that the US dollar only went up very marginally. Our index lost 14 points, was down zero point 0.2 on the week, and it was the fifth successive week that we've been within this wedge pattern that more often than not will resolve to the downside. That's why I've really called it a declining wedge. Now, I'm not saying that that is the way that it will resolve, but the fate of our index is heavily in the hands of the banks, and the banks are not exactly in favour at the moment. So it wouldn't surprise me at all to see the Australian index resolve to the downside. So let's take a look at that. Okay, so we're still languishing below the 200, but below the 6,000 point level, just above the 200-day moving average. And if we pop this onto a weekly chart, you can see this declining wedge a little more clearly. It'll probably resolve itself within the short term, I would suspect. So the way these things normally resolve within the next couple of weeks, I think we'll probably see either a breakout above 6,000 points again, or we'll see a breakdown below probably 50, 58, 50, something of that nature. So that's where we are sitting on the Australian market. Let's just look at gold while I'm here. This is gold on a weekly chart. You can see very little movement. We're really still just tracking out within this overall big picture wedge. It looks as though it wants to resolve to the upside above $1,400, but it hasn't done so yet, and still could keep fluctuating backwards and forwards within this range for quite some period of time. If we look at GDX on a weekly chart, again, there's just nothing happening here. No real movement with GDX at all. So gold was down $9. Precious metal stocks at the broadest level, GDX, we're not seeing a change, but I can tell you that the Australian producers are significant outperformers on a global basis. So if you look at Northern Star, you look at Evolution Mining, Saracen, Regis Resources, these are the best gold producers in Australia, and if you look at their price charts, they're either all at new all-time highs, or they're extremely close to new all-time highs, and that makes them real outperformers on a global basis. So some decent moves there. Looking at other commodities, copper was down slightly to 311. Crude oil went slightly the other way, up to 62.28, but still nothing from energy stocks. It just hasn't picked up there at all. There's the spot copper chart, and just to wrap it all up, the current positioning, as I said last week, it's really vital in volatile conditions to stay with where the strength is, because that's where the major players are, that's where the momentum is, and that's where the overwhelming likelihood that we're going to see higher prices. There is a natural human inclination to want to buy the bottom to try and get the best possible price you can. But if you are buying stocks that have just sold off, then you are buying weakness. And that is just not what you want to do in this sort of market. Now, there have been some good moves in local speculative stocks. There's a lot of stocks in Australia in the sub $100 million market cap area. It's an extremely dangerous area to play in. You've got to be pretty experienced and extremely disciplined to make any money out of it. Yes, you can get lucky and you can jump onto something that goes up 2, 3, 4 times. But generally, most inexperienced players get very flushed with that success. They then start chasing other things and they end up giving a lot of it back. So there are some good moves at the moment. But you've got to be very careful about what you do there. And it's certainly something that I'm putting a little bit of focus on in Portfolio Analyst for those that are interested in the sector. I'm trying to provide a few opportunities because I know that some members of Portfolio Analyst are active in that area. and we've been able to identify some good ones. But yeah, it's an area you've got to be careful about. Most of your activity should be in high quality growth stocks. That's really the long and the short of it. So, portfolio analyst this week, I'm going to be identifying some very powerful local movers again. Here's my contact details for those that aren't members that would like to communicate with me, and I'll be back with you next week. Cheers.